Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for October 10th of 2022. Please see our disclaimer for important information. Well, as we start off the chart pack this week, we'll kind of focus on labor because that was really the big issue from last week. Caused a lot of turbulence in the market. Good news is actually bad news at this point in time because we had employment which grew about 263,000 in September, which was in fact the lowest in a year and marked a noticeable deceleration in the previous 8 months average of 439,000. Yet, however, that was still far above pre-pandemic growth rates, which was the cause of the unnerving of the market, so to speak. Unemployment rate was down to 3.5%, primarily because we had a contraction in our labor force, really. So I think in some respects the market probably overreacted here. Wages decelerated, rising just 0.4% for the fifth month in a row. They're up 5% from a year ago, which is still the lowest since December. So wages of non-management, leisure, and hospitality workers, which is a pretty decent measure of wage pressure, was up 0.3% for the month and up at 4.1% annual rate over the last 3 months, which itself is the lowest since early on in the pandemic. And so, we kind of put all these things together with the August drop in vacancies and rising claims for unemployment insurance. It really looks like a labor market that's kind of on its way to a soft landing. And then, I guess the risk is that, a lot of hard landings start off as soft landings, at least from an observation standpoint. But clearly there is some favorable trends just in terms of the the trends that we see in the labor market, and obviously participation is a big part of this. And so you got to really work through the math to understand it. But in this chart, as we're looking at, we've got several charts. We've got the CPI year over year, which we know is coming down, although it's still high, kind of uncomfortably high in many respects. And then we have our average hourly earnings, which are kind of sticky at an elevated level. But they are coming down a little bit. And again, some areas we are clearly seeing some improved traction there. And here's average hourly earnings on a 12-month change for a lot of these different areas. And we hit on one or two of these, but you can see leisure, hospitality. The average hourly earnings is trending down, although it's still elevated. If you look at pre-pandemic levels, I mean, we're clearly above some of these levels in some of these areas, but they are decelerating. And I think directionally, that's the thing that we really need to be focusing on. On this slide, we've got a trend line of unemployment rate versus the Federal Reserve officials' median estimate of the unemployment rate. You can see that we were trending below that for a couple of years heading into the pandemic, and we're really back at that level right now. So, I mean, the consensus estimate is that U.S. unemployment rate should be higher than it is now, but again, very similar trends in what we saw pre-pandemic. As we continue to look at the labor market here, we've got non-farm payrolls change versus prior month, and we've kind of overlaid 2022 in the right, in the red, I should say, with several other years below that. You see the trend on the pre-pandemic levels, and then 2021. Obviously, the current levels are much stronger than pre-pandemic levels, which is part of the problem here that is giving people consternation that the labor market's too hot. But job growth has clearly eased, and you can see that in this trend line, this chronological trend line dating back to January. So slowing is good. It's just not moving necessarily at the pace that a lot of people would like to see. And I think that really goes for a lot of the data, as we saw, we talked about earlier in the first slide about some of these metrics are clearly slowing down with regard to labor. They're just not slowing down as fast as people want them to. It relates to the consumer. We've got savings rates on the left-hand side, consumer credit on the right-hand side, and we've talked about this before. And this is one of the things that kind of sends up a flag at the current juncture here. We've got personal savings rates that are moving back down to 2008 levels. So they continue to move lower on a month-over-month basis. You can see that clearly in evidence there on the left-hand side, whereas at the same time, consumption is being supported by consumer credit balances that are the highest since 2011. So, we've had a really strong rebound in consumer credit levels. Now, that's not to say that the consumer is in bad economic shape or bad fiscal shape. Obviously home values for homeowners are up, and so net worth just looking at it from a balance sheet standpoint is not out of line, but you clearly see that consumption is being supported by credit card balances now that personal savings rates have been taken down, and you see those spikes in the personal savings rates. And a lot of that has to do with stimulus payments and things like that, which of course we know are not going to anniversary. We'll kind of meander around a little bit, but one thing that caught my eye, looking at small caps, and so question is, when do you get back into small caps? And the idea is that no, you don't do it if you're on the eve of a recession, because it's a much more inwardly looking domestic exposure when you're talking about small caps versus large caps, which have much broader international exposure. But at this time, what's really interesting is that we're on the precipice of a global trade slowdown, a global recession, if you will, potentially, certainly a global earnings recession, if you look at it that way. But on this metric, again, going back to quite a ways here, 1985 on the left-hand side, small cap valuations relative to large cap valuations are not quite down to 2000 levels, but they're getting really, really close. And so from a relative value proposition, small caps are actually really attractive now. The question is, do they have a catalyst? Now, on the right-hand side, again, both these are from Bank of America, U.S. Equity Strategy, and their quant team headed by Savita Subramanian. She's very, very good. On the right-hand side here, you've got a line of best fit over a lot of these observations dating back to 1985 on current forward PEs relative to what the expected 10-year annualized return should look like. And so again, this is talking about Russell 2000, which is dealing primarily with small caps here. And so you can see the line of best fit, pretty not a real high R squared, not a high correlation, but there is a pattern that is clearly in evidence with a negative slope here. And so where we are now is where that red line shows us, and today's forward price to earnings ratio is only 10.8% for small caps, and kind of contrast that with about 15 times for large caps. And so at 10.8 times, this line of best fit tells us that over the next 10 years that we should expect to see somewhere on the order of 14% annualized returns for small caps. Again, this is not a guarantee of any sort, but it is a useful figure when we talk about long-term allocations. And so, we have to navigate the current environment, which is, I've mentioned in previous broadcasts, I think the next 6 months are going to be a little challenging just from a volatility standpoint, but there's going to be a time and a moment where we're going to want to allocate to small caps, and this is good anecdotal evidence on why. Small cap forward PE, well below the long-term average. So this is probably intuitive from looking at those last two slides. Not only are small caps cheap relative to large caps, but they're small on a aggregate basis as well, meaningfully below their average going back to 1985. So again, all the better to make this case long-term for small cap inclusion in portfolios. Bear market rallies during 2007 to 2009, and I think it's it just goes to show you that when you do have kind of these exogenous events, and I'll hazard here that 2008 there were some serious structural imbalances, and some of those just don't exist today. obviously we had mark-to-market accounting, we had technical insolvency, we had credit default swaps that were largely unknown, but helped to create a sense of security that wasn't there when counterparty risk became a problem. We don't have those issues today, and you can see, this max drawdown is pretty dramatic because that was a true crisis of confidence and something that we've never seen before and may never see again. But you can see that in the midst of that, there were several times where we had meaningful rallies. And so I just want to caution against, when we see these rallies, not to get so caught up in the moment, but just think about the backdrop and think there will be a trough in all of this. And again, I think the volatility is going to be high over the next 6 months. And so we need to kind of prepare ourselves from a cash standpoint, from a cash alternative standpoint, to maybe even looking at structured notes to kind of look out over 3 years instead of 3 months. But once we get past this, there will be an inflection point, and the market is going to come off its low because it always does. We just don't exactly know when that is yet, and we're still trying to come to grips with whether this is going to be the hard or the soft variety of that landing. There's S&P 500 performance following the inversion of the 10-year to 3-month Treasury. And so, as we've seen this happen over the years, we can see the S&P 500 performance, typically rolls over. And just as we've seen, so, this is a yield curve inversion of less than 25 basis points. And so, this typically is a good foreshadowing of us, not necessarily just of recession, but also of market performance. And we've already evidenced that in several occasions here. And then this from Market Desk I thought was really interesting. Markets don't typically bottom until the first Fed rate cut is the title of this. And so, when you see these little these bars, these kind of like orange amber bars here, those are where we've seen the S&P 500 bottom out. And then you see here in the blue line that kind of traverses across, that's the Federal Reserve's funds rate or Fed funds rate. And so, usually when you see that that first rate cut, you tend to correlate that with the bottom of the market. And so, again, I don't think we're necessarily near that yet. Obviously, there's a lot of rate increases still priced into the market, maybe 75 basis points, and then 50, and then 25, and then probably a pause in the first part of next year. And then, like I said, we're sitting here in October. So October, November, December, January, February, March. That's 6 months of potential volatility until we see that first rate cut. And I do think that that's when we should be focusing more of our energies. We'll know a lot more about the economy. I think clearly we're seeing labor slow down, which is one of those things that we have needed to see. Certainly the Fed has needed to see. And then consumption, we've got other charts coming up, which will kind of help drive that message that, yeah, we're slowing down. And it's actually a good thing from a cycle determination standpoint, the fact that some of this is happening a little bit sooner rather than later or being protracted, because it'll get us to that inflection point sooner and get us to that next market cycle sooner than would be the case otherwise. Here's wages and salaries tied to CPI. And so, we talked about wages and average hourly earnings kind of rolling over a little bit. We can see that just slightly on the far right of this particular chart, that we've seen, wages come off their peaks, but they're still relatively high. And so when you look at CPI, this is the other thing that I think the naysayers are looking at right now in terms of like gauging, is this hard or a soft landing, is that they need to see faster data change in the labor market. In other words, faster unemployment raises, which we haven't seen. We've seen a lot of, frankly, a lot of positive data out of the labor market. I think more positive than anybody thought. So this number is coming down. So wages and salaries are going down, but it's still relatively high. And so that still has people in a ball of anxiety to some degree. Here's the unemployment rate, 3.5%. February 2020. This is like just on the eve of the pandemic, and September 2022. So roughly 2.5 years later, and here we are at the same place again, at nearly historic lows in unemployment. And so, obviously there is a desire in terms of policymakers to want to see that closer to 4%. Which I do think will happen. It will come in time, though. But right now, we're in that no man's land where the labor market's actually pretty strong because there was all of these job openings that were not filled for a long time. There's a lot of openings, and openings is coming down. Challenger layoff announcements, which we'll see in a second, have actually kind of ticked up a little bit. But we're back to pre-pandemic levels on our unemployment rate. Quick look at mortgage rates. So obviously the mortgage industry is kind of taking it a little hard right now. Affordability is tight. Mortgage rates, you can see here on a 30-year fixed, are up over 7%. Now they're going to jockey around a little bit because you've got the 10-year Treasury, that's up around 3.8, and then you got the 2-year Treasury that's over 4%. So, and you see the rates here. So, I mean, we're well above 6. And so it's really, as I've mentioned before in charts of the week and market minutes, it's kind of curb mobility. Because if you're in a house right now with a mortgage that's half this rate, what's your motivation to want to move just so you can take a higher rate? And in some cases, you can, couples that are empty nesters and wanting to downsize are really not going to experience a drop in their mortgage rate because they're selling a house at a mortgage that is much cheaper than the one that they'll get on the house that they're buying, even though that house is a lot smaller. Interest expense on public debt. This is something that I think will certainly find its way into the academic mainstream. It'd be interesting to see if we see more politically charged rhetoric about this up on Capitol Hill, but obviously interest rate, average interest on debt of U.S. Sovereign debt is something we should all be concerned about because, if you see a continued rise to astronomical levels in interest expense on public debt outstanding, that implies a greater burden on our U.S. budget, which we've not had annual budgets. We've had all these continuing resolutions. But it's just going to put more pressure on things. And so we can see that, with interest rates beginning to slide a little bit higher, that is becoming an issue that we'll have to watch out for. And so at a time where, you want to try to maybe inspire more fiscal discipline, you're forced to have to pay on some of the new debt that you're issuing higher interest rates. Cooling exports. So this is, we've got a couple of charts here. Again, a little bit scattershot, but just some really interesting stuff that I came across. So net exports orders index. Again, we got a strong dollar, so some of this is not terribly surprising. But what this is showing us is that we've got global trade that is slowing down. And so, again, not a U.S. phenomenon, it's a global phenomenon. We've got trade that is, coming to, is not coming to a standstill, but it's certainly slowing down off of levels that we saw back in 2021, particularly in Germany. Germany has had the biggest reversal, and for a lot of obvious reasons, export markets that they would typically ship to are a little bit close to them right now, and also you've got the conundrum that they have on energy and natural gas is used in a lot of manufacturing production, and so the question is, are they going to shutter plants or have them run single shifts instead of double shifts heading into the winter, wanting to make sure that they're charged up enough to supply winter heating demands. Challenger job cut announcements. I mentioned this before. We watched this on a trend line basis, and this time series goes back, about 15 to 18 years. And you can see the trend line there with spikes when we have recessions. But we're at really low levels. Again, this is symptomatic of a pretty strong labor market, which is beginning to show chinks in the armor. You see the layoff or job cut announcements just beginning to kind of turn up a little bit, but they're still below the longer term trend. So we definitely want to watch this. But again, this is something that's very consistent with an economic slowdown, something we expect to see these numbers be higher, certainly well in line with historical trends if we get closer to a recession here. Here's trucking surveys and then transportation capacity in shipping. So both of these are meant to show you that we do have a slowdown in overland freight, particularly the right one, because that's capacity. This is capacity that's unconstrained in the transportation sector. So you think about transportation, think about overland trucking. And obviously you just saw that global trade is slowing down. So we've got less container ships that are porting and offloading and things like that, less containers being transferred and moved around altogether. Sales survey on the left, you can see that rolling over. It had been at astronomically high levels. I wouldn't say necessarily that the trucking survey here is bearish, but it's certainly come off its peak. And really the takeaway from the right-hand side is that, this is just a clear definition of what a slowdown is. You got increased capacity in your shipping because you've got lower demand at your endpoints and you've got lower overall production in the pipeline, so to speak. Here you've got global supply chain pressures abating. There's really not much more I can add to this. You just have, this is a global number, and I think it just reinforces everything that we've been talking about over the last 5 minutes. Foreign reserves, which is interesting. So, we've had a huge drawdown in foreign reserves, and a lot of these countries and these foreign central banks hold reserves in dollars because dollar is, of course, the reserve currency of the world. But what's interesting here, and I guess the impacts are a little bit more esoteric, I guess. You've got large drawdowns, frankly, because you got such a strong dollar that these foreign central banks are having to expend their dollars and buy their currency as a means of trying to prop up their maintain exchange rates and prop up their own domestic currencies. A quick look in at ISM Services Purchasing Manager Index. A few ISM surveys here that kind of caught my eye. Again, this data is actually pretty strong. We got new orders over 60. We've got on the survey for services PMI, we're still around 56.7. The number was ahead of estimates. Anything above 50 is reflective of expansion. We don't see this recession right now in this ISM data. Services data, we know we've seen more services inflation. The ISM manufacturing number is a lot closer to 50, and I think you can safely say that there's much more of a slowdown on the manufacturing side than on services. And again, this is another one of those areas that everybody wants to see this kind of hit the 50 mark, that we're not at this capitulation point. We're not at this recessionary inflection point yet until some of these other indicators trend down a little bit more. Here's our ISM services employment, which actually ticked back up. So, you look at these things and you look at aspects of the labor report that tend to suggest that, we're still in a reasonably strong labor market, even though it is slowing down. Again, it goes back to my earlier point that the market needs to see a more pronounced slowdown in labor numbers, and this is a survey number, so you've got employment on the services sector that's actually trending higher or indicated higher. And so, you need to see that kind of below 50 for a few periods and then everyone will get more comfortable with this notion of, okay, we're getting closer to the bottom. And then at that, when you see that, your volatility tends to kind of ebb a little bit. It tends to kind of trail off a little bit until you get to this final point of capitulation, and then the market starts moving higher. We've got a lot in this. This is housing and mortgage and blah, blah, blah. Mortgage purchase index, not too surprisingly, we saw the chart on mortgage rates earlier. The purchase index and purchasing intentions really low right now. Home builders, because of high mortgage rates and high prices, not as constructive. This home builder surveys not very not very exciting right now. And then on the bottom side, one thing I saw that was really interesting is that, amidst all of this conversation about housing affordability, that we have apartment demand, which is actually stalled out for a couple of quarters. New move-ins slow down more than anybody would have expected, which is really interesting. And the question is, maybe some of that is, do we have more inventory that is in absorption mode? Kind of hard to tell, but it is an interesting development. But housing in general, we're clearly seeing that slowdown. Unleaded gasoline, we've seen some increases lately, and obviously the announcement of OPEC Plus for their production cuts. Now, they're, to the best of my knowledge, they've indicated that they want to curb by 2 million barrels a day production, which, when you consider all of the cheats and the effective production rates and things like that, it's really more like a 1 million barrel a day cut. But still, that announcement, in addition to the supply levels, is causing these distillates, including unleaded gasoline here. You see these prices that have come down consistently for months are now actually going back the other way a little bit. And here's to end with, I thought, we talk about this soft versus hard landing scenario, and this is something that I got out of Goldman Sachs. Really interesting research. Of course, the way they call it. And this is one shop, right? There are a lot of opinions on this, and so I happen to err a little bit more closely to the soft landing side because I honestly don't think that the Fed is going to have the stomach. They're talking up a big game right now. When things slow down and we get 6 months down the road, I think there's going to be a much stronger desire to want to put the brakes on, maybe not necessarily reduce rates right away, but definitely put the brakes on raising rates. And I think that helps us maybe achieve a softer landing than would be the case if they were going to plow ahead and just continue to be completely tone deaf to a slowing economy, which I think that part's going to gain steam. But anyway, as it relates to the equity markets, you can see a soft landing. Excuse me. Year-end 22, 3,600. Excuse me. A harder landing would be more like 3,400. I think we're probably erring towards 35 to 3,600. And then you can see, that inflection point when you get to mid-year. Again, this is what I've been talking about. You get 6 months to 9 months down the road, I think you do get that inflection point, not only in terms of the economy, but also in the market signals. Particularly in that earlier slide that we saw, where the market trough is usually around the point of where that first rate cut comes into play. And I do think that's going to be about mid-year. And I think that's when we see this market begin to regain some steam. And that's very consistent in this chart, both on the hard and the soft landing. And then, by the year end next year, then you're looking at something closer to 3,750 to 4,000 on the S&P. Again, well below its peak, but again, the establishment of a new market cycle well underway under that particular scenario. We've got for the chart pack this week. Hope you've enjoyed it. Hope you have a great week, and we'll talk to you again soon. Take care. Bye.